The divide of financial information is standing by divider road this week as speculators inch closer to the government reserve's last rate-setting assembly this year. New readings on the maker cost list, PPI, which measures swelling at the discount level, strong products orders, and customer assumption lead the financial calendar in significance. In the meantime, a number of more profit reports will near the window ornament on third quarter announcing season. U.S. central bank officials will meet on December 13 to 14 and are likely to raise their benchmark interest rate by 50 basis points. Members of the Federal Reserve have entered a blackout period ahead of the meeting, which bans public speaking engagements prior to policy-setting sessions. The monthly jobs report, which shattered forecasts for November on Friday, and the Consumer Price Index data, which is due out on December 13, are two of the most comprehensive economic announcements utilized by officials to set policy. Until the latest CPI data is released, a measure of producer pricing will provide markets with another indication of where inflation is headed. Bloomberg polled economists forecast November's PPI to rise 0.2%, matching the previous month's increase, while falling to 7.1% from 8.0% on an annual basis. The core PPI, which excludes volatile food and energy components, is forecast to rise by the same monthly margin as the headline reading while falling from 5.8% to 6.7% year-on-year. The inflation picture might have changed if the United States hadn't narrowly avoided a nationwide strike by railway workers, which was expected to devastate the economy and hit wholesalers especially hard, after Congress hastily passed legislation imposing conditions from a tentative agreement reached in September. As things stand, markets and Wall Street megabanks agree on a 50 basis point rate hike next week, especially after Fed Chair Jerome Powell essentially confirmed the view on Wednesday at a speech in Washington, D.C. Monetary policy has unknown delays on the economy and inflation, and the full consequences of our quick tightening so far have yet to be felt, he said. As we approach the degree of restraint that will be necessary to drive inflation down, it is sensible to reduce. Powell went on to say that the time for slowing the pace of rate rises could come as soon as the December meeting. While expectations for a change away from the 0.75% hikes given over the previous four meetings are well priced in, investors are now wondering how long the Fed's tightening campaign will last, how high the federal funds rate will go, and how long it will stay there before any reduction. Bank of America expects the terminal rate to range between 5.00% and 5.25%, a position shared by many of its megabank peers, while B of A chief economist Michael Gapin suggested in a teleconference with reporters last week that the rate could rise as high as 6% due to the job market's remarkable speed. Risks to our Fed policy view are tilted toward higher terminal rates given the continued imbalance between labor supply and labor demand, BOFA strategists led by Gapin wrote in a note issued Friday following November's hot employment data. A slower pace of rises appears appropriate from a risk management standpoint, but strength in labor markets, in our opinion, indicates the Fed will have to do more, not less, to put inflation on a sustained downward track. With rates appearing to be slowing and eventually pausing, Wall Street's focus has shifted to the longer-term effects of a higher rate environment on GDP. In a weekly editorial, Baird's Ross Mayfield and Nicholas Bonsack, president and head of portfolio management at Stratagas, a Baird firm, forecasted that even if inflation remains low, the cost of going from 4% to the Fed's long-term price stability target of 2% becomes increasingly higher. It would almost certainly cause major disruption in businesses in the labor market, they wrote in a letter. Ultimately, we believe they will limit the rate of increase and then spend a long time to watch the landscape and the impact that may have. This viewpoint was echoed by BlackRock CEO Larry Fink, who stated at a conference last week that he is convinced inflation will fall, just not to the 2% level and during a period of economic stagnation. On Wednesday at the Dealbook Summit in New York, Fink expressed concern about waking up in a world with 2-3% interest rates and 3 to 4% inflation. In other news, an OPEC Plus meeting this weekend will focus attention on energy markets. The oil cartel agreed to maintain current production levels in order to monitor the global oil market as the commodity faces uncertainty due to China and Russia. On Friday, the United States joined the European Union, the Group of Seven, and Australia in restricting the price of Russian oil at $60 per barrel. Campbell Soup, CPB, GameStop, GME, Broadcom, AVGO, Chewy, CHWY, Lululemon Athletica, Lulu, and Oracle are among the earnings leaders ready to close out the season, ORCL. While third-quarter results were generally better than expected, Wall Street strategists have predicted minimal earnings growth in the coming quarters. According to FactSet Research, analysts decreased profit predictions for S&P 500 businesses by a larger-than-average margin in October and November. Between September 30th and November 30th, the bottom-up earnings per share estimate fell 5.6% to $54.58 from $57.79. There's something to be said for the idea that inflation creates this money illusion, where sales and profits remain elevated simply because prices are higher, especially relative to what might be considered a normal-sized drop in earnings associated with recession, Mayfield and Bonsack wrote in their weekly note. With it factored in, it appears like the economy is not suffering as badly. As a result, what we're very focused on is corporate profit margins and the level of profitability, and there we've started to see some real acute pain across the landscape, they added. We anticipate that earnings estimates will continue to fall as corporate guidance softens and costs rise.